There we go. If you have questions tonight, please put them in the chat. There may be an opportunity to voice them as well, but the best way is put them in the chat, and we have an opportune moment, I will pose them to John or to Steve. In order for us to improve our courses and to have a variety of content, Emily will have sent you an evaluation, or we'll do that tomorrow, and please send that back so we know what to offer next year. Again, thanks so much for joining us. John and Steve, thanks so much, and take it away, Steve.
All right. Thank you very much, Lori, and thanks for everybody for being out tonight. As Lori mentioned, I'm going to go through a bit of a market outlook, but I'm also going to do a little bit just on kind of the basics around how market prices in cattle are set. What are some of the key factors, and sort of tie that into the outlook. It's something we do every couple of years to try to keep everybody up to date, learning about where things are at, that kind of thing. We've done that before. So in doing that, I'm going to talk about price determination and price discovery. They're both important things, and they're both pieces of the puzzle, I would say, in terms of producers and being able to figure out kind of what's going on in the market. And that ties directly to the futures market and basis. As a price taker in Canadian agriculture, we have the luxury of being able to use U.S. futures as a way to help guide us and understand what's going on. And basis is the tool or the calculation that we do from that to figure that out. And then I'm going to talk briefly about managing expectations. And right now, with prices being where they're at, sometimes expectations either get out of whack, or sometimes not always where people think they are. So it's useful to kind of go over that. So price determination and discovery, the two really key concepts to understanding the market. Price determination is sort of the big picture. It's the overall of the price levels for a commodity. And price discovery is, how do you as a farm or a business arrive at a price, a transactions price for your product, for your commodity. And so the price determination, they're two fundamentally different things. The price determination is a lot of times things you might read online. It's things you might read in the Ontario Farmer, talking about where the markets are going, talking about where the US is in particular. The price discovery is about going to the auction, about negotiating with somebody. It's about going to the grain elevator and seeing the board price as an example. So it's where you discover and interact in the market in that perspective as a producer. And so it's important to understand these differences, understand how price determination and things going on in the market can affect price discovery. That's really important. And I think it's really important in an industry like beef cattle in particular, and the cow-calf side of things that relies on auctions, to be able to kind of have a feeling for that, and how you can then anticipate and give you the best chance of maximizing sales price. And so I think, that's important. It's also important to know that none of this is a guarantee. And sometimes the mechanisms tell us things that are quite different than what we really sort of observe from that determination point of view. But being able to try to rationalize, understand, see why that is important. And I'll talk quite a bit about that. So price determination, again, is sort of I'm an economist. We talk about things related to the markets. We talk about supply and demand, and that's really what drives and affects overall market price. So if you think about cattle, basically, the fed cattle supply in Ontario is driven by a bunch of things. The price of fed steers, it's driven by the price of feeder steers, the number of weeks back, et cetera, based on cattle coming into feed, whether it's in a background or a feedlot circumstance. It's driven by corn prices. It's driven by seasonality. You have spring and fall runs, and that's why Grey Bruce has this, Ag Services has this type of information right now, because we're weeks away from buying cattle. I buy cattle every year, and I'm weeks away from doing that. As an example, cow inventories is a big part of that. How many cows do we have out in the countryside? How many calves is that coming through in the year, 2 years after that, that kind of thing. And then on the demand side, you have another thing. Again, the same, those prices drive it, seasonality, right? We have things that go up in the summer with demand around barbecue season, that kind of stuff. The price of beef, the price of and stocks of availability of product, again, in the food industry, the availability of product at certain times of the year has a big impact on what prices are. And then the price and of substitute products, pork, chicken, etc. And one of the things that we've found more and more, I think, during COVID and coming out of COVID, where we continued into really high prices, is there seems to be limits. And again, it's difficult to test this mathematically, but there seems to be limits in terms of how much people will pay for certain products before they start making substitutional changes. And when it comes to protein, beef, it is often in late anyways. If you've been at some of the outlook presentations in the beef industry in the last year or 6 months, talking about it being a bit more of a luxury product, but it's still because it's a lean protein and because it has a very specific place, in particular with the availability and how people see ground beef in particular within the variety of cuts, has a pretty unique place. So as I mentioned, the U.S. sets the market. We're for the most part of an integrated global market, but the U.S. is the major player, and our integration with them, because of our free trade agreements and because of our geography and similarities in markets, populations, that kind of thing, makes the forces of livestock inventories, all those kinds of things in the U.S. really set the base level for prices here. And so, as long as there is that free trade and movement, we've seen cases or examples where that's been disturbed, like during the BSE crisis, for example. But as long as we have that movement, then Canadian prices aren't going to get too far out of line with the U.S. prices. Otherwise, product or supplies would start moving one way or the other pretty rapidly. And we call this arbitrage. And what we've seen in the hog industry in Ontario in the last 2 years, we've went from sending about 1.6, 1.7 million market hogs a year into Quebec to be processed by Olymel, down to about 300,000 now. And those other 100 or 1.4 million roughly are going to the United States. So it's actually changed the pricing that we have for market hogs in Ontario quite a bit, because we're arbitraging a little bit closer with U.S. prices because we have such a large volume. It amounts to about a third of our production going into the U.S. On the cattle side of things, we're not moving as many fed cattle into the U.S. like we were before BSE. Before BSE, we're about 130, 150,000 head a year going into U.S., in particular Pennsylvania for slaughter. Now we're at about 75 or 80,000, which is still not an insignificant number, and it's large enough and it's increasing enough that trade is helping sort of help buoy the price in Ontario a little bit. And I think it's important and becoming more important because it's helped keep prices here up but just a little bit. And ultimately, when we talk about this, we'll sort of look at what the overall price level is, and we'll look at a widely quoted U.S. price, or in this example, the cattle price. And this could be a contract price. If you're out west, for example, you might use a regional price, a basket of steers from different auctions, etc. If I was doing a sheep presentation, I'm talking St. Joseph, Missouri, which is a major auction mart there. Different areas where you might use that basis, and I'll talk about how you could do that at a local or individual level. So, the really sort of driving force in the Canadian and the North American beef industry is the continued decline in the cow herd. The U.S. has contracted 2014. It peaked again in 2018, and now it's in about its fifth year of contraction. It's not maybe as steep a decline as what the U.S. had seen in some other years, but it's a significant enough decline, and there isn't really an anticipation of it rebounding maybe quite the same. And I think in general, what we've seen in the U.S., both in the hog and the cattle side, is the cycle in terms of the up and down, in terms of the cow herd itself, maybe not prices, but the cow herd, that it's flattened a little bit because the outlet for the U.S. when they have excess is exports, and the export market's been really important for them, and that's helped temper some of the increases in gains you might otherwise see. From a Canadian point of view, our herd has declined about 32% since BSE, so since basically the end of 2005. Our Ontario herd has fallen by about 42%, and it's declined another 5% in 2023. And I tend to use the July numbers, so the herd size on pasture, if you will, in the summer is my gauge as opposed to end of the year, so January 1st. But the bottom line is that we've seen declines, and there really isn't a great indication of increasing the herd size anytime soon, despite maybe where we're going from a price point of view. On the demand side, sort of two key things. One is that overall food and meat demand continues to grow, largely because of the population, but within that, the demand for meat, lean protein is growing pretty significantly, and different types of lean protein, and that's where ground beef has some opportunity to come into that mix, where there's a lot more demand from a lean and an extra lean ground beef point of view. Chicken is really the only meat product, and again, it varies a little bit from year to year, but for the most part over time, it's the only meat that's seeing an increase in a per capita basis. So any increase, um, that we are seeing in terms of demand, for the most part, is really driven by population growth, which in and of itself isn't insignificant. It's large and it is growing. But on a per capita basis, really, we're losing a bit of ground in that regard. And I think it's pretty unlikely to think that you can reverse that trend per se. But what you have is a market where people are eating meat and a lot of other products, if you look at fruits and vegetables and that portion of the diet, but they're eating in fairly fixed proportions, and substitutability maybe isn't as profound as we once thought it was. And it's because health and convenience and the type of product and what people are looking for is a lot more specific than it once was, despite some of the price challenges and issues that I think that people have had in general. And that's been able to keep demand pretty steady. So, on the beef side of things, imports are a big part of the market. That's really true for all of Canadian agriculture. Even in the supply management side of things, we rely on imports to meet all of our domestic demand in various forms. And beef is no different. It's about 20% of our demand. In the Ontario case, it's about 35% of our beef consumption. Again, how imports get used in the system is a little tricky. They're very much a just-in-time product. They are generally boxed beef, so they're going into, for the most part, Cargill, or a couple other wholesalers, and being cut into different product points and meeting some of the more local demand that sometimes we can't always meet. 2023 saw imports fall by about 3%, which isn't uncommon. We've seen a bit of a gradual decline off the peak of about 30% in 2016. We've been kind of in a gradual decline since that point, but it's still a significant part of the puzzle and plays on a number of things, including prices. In terms of the domestic market and trying to figure out where things are going from a price point of view and looking at where stocker prices have been recently, one of the major drivers is that of the cattle on feed. And cattle on feed is a very sort of cryptic term, both in the US and Alberta and the West, as well as Ontario. In the United States, there's a really rigorous process to estimate cattle on feed. It does focus on large feedlots, and basically, for all intents and purposes, if you're a major feedlot in the U.S., you have to fill out really regular information to help outline how many cattle you have on feed or how many cattle you're planning to place. We don't really have that in Canada. Canfax, which is a company out of Calgary, does a little bit of that with larger feed yards in Western Canada, but it's not really the same as what they do in the U.S., and we have nothing here in Ontario. And so that's a bit of a challenge. So I try to do this kind of analysis throughout the year using a variety of different sources to try to get a handle on it. My math would be that, and this has a big impact on prices, is that about 40% of the cattle on feed in Ontario is from Western Canada. So and we're about 40% this year. So since BSE, we've been averaging about 40%. So, the bottom line there is we don't have enough calves around in Ontario to supply the demand from a feedlot point of view, which is driven by the retail demand, in particular from Cargill. And so we're buying cattle from Western Canada. Now, there's a number of factors that play at that. One is that we can get access to those cattle. They're not being bid away by other producers out there. That the feed yards here are going to look for cattle in the West and so on, and that's pretty significant. So that's a big one. The other one is how many cattle are sent to the U.S. I already talked a little bit about that. About 8% of our cattle are sent to the U.S., and that has another large impact in terms of price, in that it really pushes the feed side of things and really pushes the packer side of things in Ontario, and trying to effectively keep them more honest and whatnot. And so on the chart below, basically, you have the purple line, and that's the total amount of cattle that we're slaughtering in the province in any year. And then the bars represent how much we are producing in Ontario. That's the blue. The red is the Western Canadian calves that are in feedlots. And then the green line is basically how much we're sending to the US. And the gap between those two numbers is really, generally speaking, filled up with with Quebec cull cows. For the most part, dairy cull cows that come out of Quebec, and for the most part end up in Cargill, generally speaking, 1 day a week. And that's kind of ebbed and flowed as time went by, but they fill that gap. On the slaughter side, for 2023. We averaged about 9% less than 2022, which again is a representation of less cattle around, the slaughter numbers declining. And again, recognizing that, again, if you think about the nature of how Ontario operates, we're getting about 850 from Quebec. That's down also in that same range, about 8%. Our slaughter plants are down about 8% as well. That's down about 1,100 head a week. Again, provincial plants are unique in that for the most part on the cattle side, they're doing a fee-for-service business to producers like myself who sell cattle direct to consumer for freezer beef, etc., as opposed to buying an animal from the producer like Cargill or St. Helens would do, processing the meat and then selling that meat in a wholesale or retail environment. So it's a different concept. But I think one of the unique things about what we've seen in this declining period is that it has helped buoy prices a little bit. Prices are a little bit higher than they would otherwise be, but Cargill is the only plant in the Cargill system in North America that operates on a single shift. All of their other plants are running for the most part 24 hours a day, 6 to 7 days a week based on the concepts they have for cleanup. So you could argue that Cargill is running at half capacity. Now that's not completely true because of the way they've structured themselves, but it is a reflection of the fact that they're not running nearly the cattle through that plant that they could or would in a like scenario. And it comes back to the previous slide around not having enough cattle around, and that comes back to this idea of a declining cow herd, etc. How have we dealt with that? Well, one of the ways we've dealt with that is we have to deal with stronger demand is that we basically put more weight onto our livestock. And that's true across the board. It's true in terms of hogs. It's true and not maybe quite as true in sheep, although the move above 75-pound lamb seems to be growing. It's certainly true in cattle. It's true in the dairy industry. You know, the test for butterfat, for example, in dairy is 3.6 kilograms of butterfat per hectoliter of milk, and now we're testing out for most farms at least 4.2 is probably pretty common now. So again, the model, we're getting more of production from a single animal or a single livestock unit. In the case of cattle, it's heavier carcass weights. And so fed cattle averaged in 2022 about 873 pounds, which is a pretty heavy animal. That was down about 2% from 2021. 2023, we're up 1%, and we're at about 882 pounds for an animal. Now, again, that's not as large as what we saw all the way back into 2016, but that was a point of record prices. So it wouldn't surprise me over the next year and a half or so as we continue to see fed cattle prices stay at the level they're at, which we'll talk a little bit about, to see those numbers start to ramp up. One of the things that you don't have quite the same with in Ontario or in Canada that you do in the United States is the grid system that the US has in terms of cattle pricing. Once you get too heavy, the discounts are pretty significant. In the Canadian system, there will be some discounts, but not as prevalent, and so that plays into it quite a bit. The other side of things in terms of looking at the retail price of this is that we haven't seen full transmission of the price increase for the most part through COVID. We've seen a few examples of it, but for the most part, as we went through the last 2 years or so, as the price of beef has went up quite significantly because of shortages, corn costs, that kind of thing, the the price hasn't went up to the same degree. And this does go back to this idea of how beef fits into the meat complex, how you're playing against the substitutability with pork and chicken, and how you can only go so high in terms of prices, et cetera. And so that's important from understanding basically, you know, at what point does basically the demand on the retail side sort of peter off enough that you're going to see basically that value push lower through the system. And, you know, that's one of the challenges that you face when it comes to this idea of market and price determination. So then in terms of looking at price discovery, again, it's this idea that you have a transaction. You're a producer, you're going to try to get yourself out in the marketplace, and it can be done at a market level or individual farm level. And in general, price discovery in Canadian agriculture, in the case of cattle, takes the basic formula of the US price divided by the exchange rate, plus or minus the basis, and we'll talk about the basis, that equals the Canadian price. And there's some nuance about this. And so, whether you're observing market prices at an auction, or whether it's a formula, or whether it's a contract, or whether it's a spot market negotiation where we're dickering back and forth with people on a price, or where it's a board price like you would with corn or soybeans, where the elevator is posting a price every day that they offer for number 2 yellow corn, for example. It all comes back to this basic formula. And if you're dealing in cattle, you can get this information as the base, the US price, through the Chicago Mercantile Exchange, which is basically a live system for managing futures market prices for livestock, for grains and oilseeds. And the link to look at those on a real-time basis was provided there. And so basis is basically the sort of the more difficult part of the process. And the basis really is the difference between that reference US price and our own price. And it's really, because you've already adjusted for exchange rates, it's really a reflection of local demand, local costs, local supply, seasonality, a number of different things. It's effectively that regional component. And so again, it's the difference between one region and a futures price. It could be one region and a reference price, like I mentioned, in terms of Nebraska or excuse me, San Jose or St. Joseph, sorry, from Missouri for sheep. It's basically a reference price. Now, the thing to remember about cattle and livestock is that basis is something that's only observed after the fact. So I'm not sure how many of you guys get the daily farm market news that the Grain Farmers puts out. It comes through Ridgetown College. It's something the ministry's had for a long time, and we're really the only jurisdiction in North America that offers this. And that goes back to this elevator price or board price. That information that you get daily has a basis level, and that basis is observed as the board price occurs. And so it's a little bit of a different beast than the basis in cattle, for example. The basis in cattle is observed after the fact. And if you're dealing with your individual circumstance, it's really only after you sell the cattle that you know what the basis is. And it's really specific to every animal for the most part, because it's not a standard price that any one animal is receiving like it is for a bushel of corn. And so it is a very unique thing. And so if you're marketing cattle relative to marketing corn, and I do both, it's a different study in terms of figuring out how that plays out for you. And in the cattle side of the things, I think it's important to understand that the basis that I'm going to talk about, which is a really useful tool to track and to understand, it's really telling you what's been going on lately. It gives you an idea for what you should expect, and what's normal, but it's not a guarantee of what's going to happen. And so, you don't know really what that basis level is going to look like until you experience it. And it can be a wild card, and it can be very specific to a number of things, which I'm going to talk about. At a regional side of things, the basis is on what we call an export basis when we have surplus in the area, too many animals around, or more than basically is necessarily required. And this means that it's lower than Chicago when adjusted for exchange, and it's a negative number. And we're generally on an export basis for fed cattle in the late fall and through the winter. Okay, so we generally have an excess at that point. If we have a shortage of cattle or a shortage of product in general, of other things, that's when we talk about an import basis, and it's often referred to as a positive. You're above that reference price, and we're usually on an import basis for fed cattle in the spring and the summer because we're bringing those cattle in. And then feeder cattle, we're always in excess because we're importing all year long. So we're always in that side of things. And so this represents the 5 and the 9 weight basis for Ontario fed steers over the last 2 years. And so this information is all available weekly on our ministry statistics site. The link is provided here. And the black line basically represents where we've been this year in 2024 so far. The blue line shows over the course of the year where 2023 went. And the red line represents the 5-year average from 2023 back 5 years. And so what you can see basically is that the black line for the first number of months, we're into, March now, pretty well to the end of the first quarter of the year. The basis in Ontario for 5-weight cattle, for 5-weight steers, has exceeded that 5-year average. And what that tends to mean is that it's on a stronger basis, it's more positive. And that would tend to mean that there's a more than the normal shortage in the Ontario market. And that would line up with the slaughter volumes falling, et cetera. which would oftentimes be a reflection of the fact that there's not as many cattle around to be slaughtered. It would reflect in the fact that there is more cattle going to the US, so that plays into the shortage, etc. And what you can see is, and you look across the graph, that has a fairly significant seasonal pattern. And you can see last year was kind of a curious study, the blue line. A good chunk of the year above, indicating excess shortage. The middle of the year, the pasture season, or at least the summer season, below. In other words, either cattle weren't moving as much, or there was the view that we had an excess supply. On the 9-weight side, again, it's a little bit different because the 9-weight side in Ontario is more exclusively going in feedlots as opposed to 5-weight side that are by definition going to be into a background program. That background program could be on grass, or it could be in a contained feed environment. It depends a little bit, but on the 9-weight side, you're pretty much universally going on a heavy corn diet. And it's this year so far been quite a bit weaker than the historical, the red or the blue, which was last year. And that's generally an indication of, there are enough of these animals around. And this, I think, again, would largely be a reflection of the fact that it tends to be that our imports from Western Canada tend to be in this heavier categories, not as prominently in the 5-weight category as they are in the 6, 7, 8, 9-weight categories. And so that would indicate that we're a little more flush in those cattle, and people are bidding a little bit less, and that means a basis that's a little bit weaker than normal. On the fed cattle side of things, we really have sort of two models in Ontario. We have the rail grade, so that's direct to Cargill or St. Helens in particular, reported on a carcass weight basis. And we've seen the basis, and we've seen really strong prices, and we've seen the basis for the first several weeks of this year be pretty high relative to average, although we've kind of dipped below that average the last couple of weeks. And that plays off at the end of last year. If you go to the far right column of that rail grade one, where the blue line was quite a bit above that average, and that sort of continued through into the start of this year. On the live side, this is animals that are going through a live ring, which for the most part is Olex on Thursdays in Waterloo, Elmira. So those are basically kind of like sheep in that it's a ring directly for slaughter. The cattle that are going through that tend to be kind of a fancier animal, tend to be a little bit higher quality, would likely grade a little bit higher than average, and they're being bought directly by packers in Ontario. And again, the market follows pretty closely these two numbers, day to day, week to week. But the basis has been roughly the same in terms of strength in the market. So that's also important in terms of those two key markets sort of keeping each other honest. So in terms of looking at futures markets and basis, there's a number of things you can do as a producer to help you sort of understand where things are going, give you some better guidance, etc. The Beef Farmers of Ontario, the website's listed here, provides daily, weekly, monthly reports. There's a ton of detail in there, a ton of information about price determination, as well as price discovery from the perspective of what's happened recently. And so you can click on this link and it'll provide you exactly the information that I'm going to take you here right now for the date of February 22nd, 2024. You can do this every day of the week if you want it. It's really an exercise in trying to understand where things are at and where they're going. And they do vary a bit every day, obviously. But so the basic gist is that on that day, February 22nd, the 5-weight category at Cookstown. So again, the idea here is that you as a producer are thinking about your circumstance. Where do I normally sell? So if I normally sell at Cookstown, for example, then I might use the Cookstown data as a tool and track it over time. In particular, track the days I sell, but I might also track a couple sales before or a couple sales after the normal days that I sell as a guide to give me a feeling for how things go. I could look at volumes on those days, that kind of stuff. But on February 22nd, the 5-weight category for steers ranged from 320 to 435. So one of the tells about this particular set of data is that spread. That's a really wide spread. Normally, you don't have that kind of spread on a 100-weight basis on a particular day. So again, this is an example of where in certain circumstances, if you're there and you can see what's going through the yard, it gives you a tell on it. So that to me would say that either the buyers were kind of sporadic through the day, or there might have been a larger number of small groups of 5-weight cattle as opposed to larger, more consistent, higher quality cattle that would drive you to a more narrow range. Again, it's not a perfect tell. The best thing to do is be there and understand and sort of see how things go. And you can usually get a pretty good tell for that from my experience. But right off the hop, just looking at the data, it tells you something about what went on that day. So on that particular day, the nearby, which is the closest month's Chicago futures market, was 252 US per hundredweight. Okay. And if I'm sitting there as a producer thinking, what does May look like? What is my sale into a special sale at Cookstown, a special sale somewhere else? What's that look like? So the May contract for 2024, that same day, was 259 per hundredweight. And so that's what we call carry in the market, where the out price is higher than current market price. And you can apply this concept to any of the commodities, livestock, grains, and oilseeds, etc. And that's a 2.9% increase over March. And so the dollar is roughly 74 cents. The expectation is it would be flat till May, because you can go on here and look at that stuff. So in terms of that calculation, you're not really figuring in too much appreciation or depreciation in the Canadian dollar. And the May basis is $30 over. So in other words, it's on an import basis, and it's $30 above whatever the US is. And so there's two different ways that you can go from that day. If you're thinking ahead to a May sale, what prices might look like for a 550-pound weight steer. So the first is using the futures and the basis. The 259 from May divided by 0.7421, which is the futures market, or sorry, the futures exchange rate out to that date, adding the basis, that gets you to $379. The carry in the futures market is basically 2.9 cents. So you take that original range I talked about, 320 to 435. So if you assume that that range is kind of representative, then the price in May, based on that carry of 2.9%, could range anywhere from 326 to basically 448. Again, pretty big range. And this is the example of where it ties directly into my next few comments around expectations, is understanding what your cattle look like. And so this is another example of taking that kind of concept and moving it out over the next year. The black line represents 5-weight cattle, and the blue line represents 9-weight cattle. And this is basically using that concept of carry in the market. I'm not adjusting for a 5-year average basis here. And the reason I'm not adjusting for a 5-year average basis is right now, the market is usually quite a bit above our 5-year average basis. So it's tending to underestimate where things are going. But what you can see is that as we get through into June, et cetera, based on where we're at right now, 5-weight calves could end up over 420 again on the steer side of things. And on the 9-weight cattle side, you end up getting upwards of 340. So strong prices and relatively sort of sustained prices over the next little while. Again, from my perspective, making sense, going back to this idea of price determination. We've got fewer cows around, we've got fewer calves coming through. And then I'll talk about corn prices in a second, but you've got basically corn prices falling pretty significantly. So what that's done for the feed margin, the feeding margin for steers, and this is also available on our ministry site. This derives directly from the formulas we use for the risk management program for feedlots. And this is basically taking a 9-weight steer over 26 weeks to a 1,500-pound steer. And you can read the details on there. It's feeding them 1,800 pounds of dry corn, corn silage, et cetera, et cetera. It's a formula we've been using for quite a while. And pricing out as if you were buying that corn. Now, again, a lot of guys are growing corn silage themselves, homegrown feed, et cetera. But this is about sort of the pure economic cost, or we call opportunity cost, of basically buying corn to feed into this. And what we've seen over the last year, the blue line, is a relatively strong margin, largely because we've had somewhat temperate 9-weight cattle prices, again, over 26 weeks. We've had continued strong fed steer prices, and we've seen pretty much a gradual decline over the last year and a half or so of corn prices, which has seen a gradual decline in the feeding costs. If you go back into 2002, 2003, if you go back into even before that, 2001, there were weeks where, or there were feeding periods where we were talking 900, 960, 970, almost. I think the highest week we had was just over $1,000 for the feed cost of taking that 9 weight to 15 weight animal. Now we're in the neighborhood of what we think for 2024 to be around 725 or $800. So that's pretty significant. On the fed cattle side, same kind of thing. We're at about $4 a pound or $400 a hundredweight on the rail right now. A bit of seasonality comes in as we move through May, where that number does tend to fall a little bit, and I would kind of expect that to be the case. It's possible if we feel that there's significant shortage, or if all of a sudden, we have a major delay in corn planting and the price of corn starts to jump, that could change things a little bit. But I think, again, we're in that, 4 to 375 kind of range, is my guess, in terms of where that's going. And then that would feed out through the end of the year. And sorry, I cut my number. We're actually at about 620 ahead on the feed cattle, on the fed cost side through the rest of 2024. Again, knowing that in the last year or two, we were upwards of $1,000. So that's a significant decline. Now, one of the things I think that's important to remember when we sort of put all these concepts together is that, cattle and sheep are and when I say cattle, feeder cattle are really the only two sort of commodities in North American agriculture that really rely on auctions for the most part anymore. Everything else has some different models in place. And that's a good thing, because there's, an auction market can be a very solid way for price discovery to happen, etc. But there are a number of challenges associated with this, with auctions. For example, as many of you would be aware, we've moved to a number of special sales in Ontario, which are intended to try to bring higher quality together, bring in and increase the number of buyers, trying to provide information that will hopefully drive up the price for producers. But they're doing that because presumably the animal is of a higher quality, etc. So there's a lot of value in auctions, but you have to understand what the auction is offering in that regard, and try to figure out where that fits in terms of both your own marketing as well as your own production. Most of the fed cattle in Ontario are sold direct to contract. Now, direct contract can mean a bunch of different things. It can mean that you price on a formula. It can mean that you price off of some reference date, or it can just mean that you're direct contracting in that you set a delivery date for your cattle, and you're given a price for that date, and that's the price you receive. And that tends to be the more common situation in Ontario. But there are some offerings, based on some of the types of calculations that I've outlined here, etc. But there are advantages to direct contracting, but there's some risks associated with it. And understanding your cost of production, which John's going to take you guys through, understanding your feed costs, understanding your feed usage is really important to make direct contracting a beneficial process. The other side of this is really understanding product attributes. And this is kind of a general marketing thing, but in cattle, it's a really important thing, because, again, to contrast that to corn, you don't have a standard unit. A bushel of corn, for the most part, is a bushel of corn. But with stocker cattle, etc., every animal is different, right? You can try your best as a producer to have, a group of 20, 6-weight calves that are, all preconditioned, that are all, vaccinated, tagged, that are age verified, all the various things that you're looking for, dehorned, whatever the case may be, properly vaccinated. They're still not completely homogeneous, and that can be a challenge. And so understanding the differences between your animals and the market that you're trying to operate in, especially in the auction system, is really important, right? Knowing that heifers obviously are going to return a different price, knowing that your breed can have an impact. If you've got Herefords, chances are you're getting the lower end of that price range than the higher end, right? There's a number of things. Are they in good condition? Are they preconditioned? Can they be put into individual groups, etc.? All of those things in terms of an attribute play in significantly. And so putting this all together, one of the key ways is to make sure you're tracking key pieces of information. And that helps you manage your expectations, right? So remembering that last week's price won't necessarily be this week's price. Know your cost of production, track it over time. Record the market prices you receive and the attributes of your cattle, right? So it's not just about average weight. It's about, again, and this depends a little bit on your business model. If you're somebody that basically is only ever selling homegrown produced calves, then, for example, you've got a Charolais herd, then that's what you're selling. You're not varying too much from that. But in general, you can get into things like, how many heifers, what kind of condition where they were in, if you didn't vaccinate, for example, how did that play in? Did you sell at a special sale? All that kind of stuff. There's a lot of different things you can do. It's also important to look at that sale for the day you sell and understand, were you the high, the low, the average? Where did you sort of fit in that range? What was the volume sold? If you don't have or you don't sell at a specific auction, but you want to try to look around, you might, for example, track Cookstown and Keedy, for example. And, again, Keedy's got the special sales, but they tend to be tied to specific calf clubs. So you're picking their Tuesday or Wednesday sale kind of thing. It's a reference point. It helps you understand. One of the key things I think in terms of being able to use this information is to try to go to some sales, see your cattle sold, which, having done it myself, it's not always a fun thing to do depending on the way the market is going, etc. But it does give you a lot, maybe not always as much information about your own animals, but it does give you a lot more information about how prices went that day. And it gives you a flavor of what's going on. Even just to see how many people are generally bidding on any group of cattle is a big tell as to how liquid the market is, and to kind of understand what things you should expect as time goes by. And, for myself personally, I always try to go to a few sales every spring before I plan to get into the market. And I'll pick some in different areas and kind of use it as a gauge, just to looking at sort of the intensity of the auction, where auctioneers are starting, where the auctioneer starts the bid price for any particular group of cattle or anything, whether you're buying a tractor or a four-wheeler, it doesn't really matter, but where that auctioneer starts the price does set the tone for the market. And I always use the adage that auctions are kind of like your heart. They have a rhythm, and the rhythm can be maintained, and the rhythm sometimes is maintained at a high level, even though you're maybe not got a lot of exercise going on because of the nature of the way they operate. Once you have your heart rate coming down, a lot of times, depending on where and how quickly it comes down, your heart rate won't jump back up as much because the rhythm of the auction is pulling it down. But when your heart rate's elevated, the auction and the heart rate of the auction will tend to stay there. And I think that's pretty true. And it means different things depending on the auction and the nature of the auction. But it is something, if you're part of the industry over the long term, you can really see that in how things go. And so I'm going to wrap it up there. There's a ton of information available to individual producers. The BFO does put out an awful lot of information. In some ways, it's too much for most people. You kind of have to pick and choose, and hopefully, which is one of the reasons I started doing this presentation, because I think it can help people sort a little bit out as to how they might use some of that to better their own circumstance a little bit. But again, it's not the be all and end all, but it is something that hopefully allows you to manage expectations and hopefully manage selling your cattle a little better. So with that, I'm going to stop sharing and open it up to any questions.
Thanks so much, Steve. That was great. Does anyone have any questions? You can put it in the chat, or please unmute yourself and ask it directly to Steve. Don't be shy.
Yep. Oh, not really a question. I just want to, thank you that you're helping build quite a good resource library. And I'm usually a creature of habit, and I like to get up in the morning and look at markets and see what's available. But I'm obviously shy on my resources. So thank you very much for filling in a lot of gaps here that I can build quite a good little ledger for investigating prices and looking at where the markets are at on a daily basis as well as a weekly basis.
Yeah, no, you're welcome. And if you have questions going forward, we're both John and I are easy to find, basically. So
Last call for questions. Hearing none, I'd like to thank you very much, Steve, for being with us tonight and sharing all this great information. As you said, people can reach out directly to you or reach to us, and then we'll get you connected with Steve. So thank you very much. And we'll send you off and turn to
Thanks,
John.
everybody. Have a good night.
Thank you.
All right, thanks, Lori. I'll just get my screen shared here. All right, does that look okay, Lori?
Yeah, I just have, it looks great. Thank you.
Okay. All right. Okay. Yep. Thanks, folks, for joining and or tuning in if you're watching this as the recording. So I'm just going to be talking a bit about some of the benchmarking initiative that we've been doing for the last number of years here. There's lots of good benchmarking you can do internally, like setting targets for yourself and watching progress over the years and trying to come up with some ways of improving the performance of your operation, just comparing yourself to yourself. So there's lots of good ways to benchmark that way. And some of the reason why some folks benchmark internally, because there just isn't a lot of benchmark information available externally. We used to have, going back quite a number of years, some good benchmarking data through OMAFRA, through the Farm Management Analysis Project. And then we did have some benchmark projects over the year. We had a cow-calf one quite a number of years ago now that worked with some of the cow-calf producers on a on-farm data collection. So those are pretty hit and miss now. There's not a lot of them. And I have presented a few times with either the Grey Ag Days or the Grey workshops, courses like this on the Canadian Cow-Calf Cost of Production Network. That's been an initiative that we've been doing with, probably five years now or so. It's led by Canfax Research out of Alberta, and it is a national effort that is working with cow-calf producers across the country on collecting cost of production information and putting together typical farms. And there's 6 typical farms in Ontario. Like I say, I've presented a few times on that with the Grey Ag, so I'm not going to be talking about that today. But I would encourage you, if you are a cow-calf producer, to have a look at the Canfax Research Services website. And in their cost of production section, you can see all of the different farms that have been developed through the network across the country, and as well all of the cost of production analysis that they've done. So lots of good benchmark and cow-calf information there. But what we have done in Ontario is we had to look at, okay, we don't have these on-farm data collection programs anymore, and any benchmarking is sort of hit and miss, whether there's funding available for different groups to do it. So we started looking at what data we do have. So we have been looking at and using the business risk management data that we have within the business risk management programs with Ontario, and seeing what we can produce for benchmarking. And this is what I'm going to be presenting some of the results on from some of the data that we're doing on the beef data side of things. So for the beef sector, we have 2 different farm types, and there's 13 total farm types that we've looked at the agri-stability data and put together farm types and benchmarking information. There's 6 livestock operations and 7 crop or farm types in the data. So I'm just going to be highlighting today the beef cow and the cow calf, or the feedlot information that we have. So what we've been doing with the data is setting criteria of what would constitute a farm that we're wanting to make sure that is in the data. So we're looking for specialized farms, so a specialized cow-calf operation. So 80% of their sales comes from beef, and they have beef cows as well. So we're trying to get a fairly pure beef cow operation. And then on the feedlot side of things, again, 80% of their commodity sales comes from fed cattle. And we can look at the livestock numbers to make sure that it fits within a feedlot as far as they've got livestock coming in. It's not a cow-calf herd that's finishing off just their own calves. It is sort of a dedicated feedlot. So we do look at those. So you look at, and this just gives you an idea of some of the breakdown or the profiles of these farm types for the cow-calf. We've got the 26 farms, and I say cow-calf, it could be beef cow operations that are finishing either to backgrounding or to full market weight as well, because we don't have definitions in there to cut it off at cow-calf. So it could be, they are beef cow herds in this definition. There's 26 farms that each year, an average size of 78 cows, and the average revenue is 143. So if you're thinking cow-calf herds in Ontario, yes, there's lots more cow-calf operations out there. Why do we only get like 26 a year? I think one of the big reasons is that 80% of the sales is coming from beef. A lot of cow-calf operators, a lot of beef cow operations are diversified, or they have a significant cash crop as well, or they may be having, you know, a sheep operation as well. So they've got other enterprises that the calf sales, the beef sales, do not represent 80% of the sales. So we are trying to get to a specialized farm. So that's why the numbers are smaller than you would expect, and smaller that you know that there's lots more cow-calf operations out there. On the feedlot side of things, we do have quite a good sample size when we look at the feedlot information that we've got. You know, 337 farms a year in the data, an average size of 874 heads sold per farm, which you know, the average sales was in the $2.2 million range for in this farm type. So we look at each over the 5 years for each one of these, and it's kind of a rolling 5-year average. So this is what the two beef farm types that we have within the agri-stability data. And then we use like a standard financial reporting setup that is being used by other. Just trying to move the bar here. I can't actually see the. And it's not going to let me. I was trying to throw it off to the side, but I can't really see the top of the thing. But you won't have that on your screen. But I was just trying to get it out of the way here. But it is standardized financial reporting format. If you're familiar with Larry Martin's Agri-Food Management Excellence Group, he has a sort of a farm executive program. He uses this format, working with them on doing some financial reporting, financial benchmarking. There's other accounting firms that are starting to adopt this reporting format, and like BDO Canada is one that is doing that, and they're doing it internally within their clientele to put together the, you know, in the standard format. So it's categorized all the costs into 5 main cost categories. So 3 of them are operating costs. So the cost of goods sold would be those direct inputs, like in the livestock side of things, it's you know, purchase feed, livestock purchases, vet, breeding, and then on the crop side of things, it's seed, fertilizer, pesticides would be those direct inputs that are go into generating the outputs. And then the direct operating expenses are mostly machinery and labor is included in that. There's other aspects in there, but some of the main ones in the direct operating expenses are machine operating expenses, and then labor expenses in that. And then operating overhead expenses would be all of those overhead expenses, utilities, insurance, that are you know, those costs to do business, you know, as far as the accounting fees and membership fees and those types of things would be lumped into that. And then the second category, second groups of categories, is in the capital category. So the cost of capital would be the depreciation, leases, rents, property taxes, would be in that annual cost of capital. And then interest expenses is on its own, so operating and term interest. So it is, this benchmarking is financial performance benchmarking. We do not have a lot of production information in the data. We do have some numbers, like I say, with, you know, the average number of cows in the herd and the average number of livestock sold on the feedlot side of things, but we don't have a lot more production information. So it is a financial benchmarking initiative that we have within the agri-stability data that we have. So we are looking into potentially other ways that we could be potentially tap into things like the risk management program to make the link between some of the financial and some of the production information that's reported within that. But we're still working on that piece of it, and we don't have that fully fleshed out how we would do that and what the data looks like when you try linking it. Sometimes when you try linking the two different data sets, it gets some wonky results. Sometimes they're just not linking. The financials just aren't linking or making sense when you start linking in some of the production information from another data set, right? So we are looking into that, but this is just sort of a pure financial benchmarking. So what we're doing is then measuring financial efficiency. We take all of those costs and divide it by the farm revenue. So everything is on a percent of farm revenue. So it is an efficiency measure. So it's basically telling us how efficiently you're spending money to generate outputs. So it's just sort of getting a sense of just how much it takes on the cost side of things to generate revenue. So it's measuring financial efficiency. So all of the benchmarks within this database is tracking those financial is tracking on the financial efficiency for these. So within all of these cost categories, one of the nice things, like I say, we've got 13 different farm types. It does give you the ability to start comparing across farm types just to get a sense of different cost structures of different industries. So I'm just showing the feedlot and the cow-calf, but of course, if you started comparing, to some of the other livestock sectors, or even if you're looking at some of the crop, like we've got a field crops one, you can start looking at, some of the how, these different cost categories differ across the different farm types, because we are using a consistent formatting method to create the results. So it does give you that ability and that consistency to be able to compare across them. So so you see, not surprising with the feedlot, you've got, cost of goods sold. Big piece of that would be livestock purchases and purchases feed. So livestock purchases would be a big piece of that. So feedlot, you also see that in the swine finishing one as well. But that cost of goods sold is a big one. The cost of goods sold is a term that's just starting to get used in agriculture. It is something that was used in other manufacturing sectors, but it is something that's becoming a little bit more and more used within the agricultural setting. And again, it's those direct inputs. So less so on the cow-calf. You'd still have some livestock purchase and some purchase feed and minerals and supplements and those types of things. And then the bulk of the feedlot expenses would be in that livestock purchases and purchase feed, or in the feed side of things. And the direct operating is again mostly machine operating and labor are the ones that are included in that. So the cow-calf is a little bit heavier on the direct operating compared to the feedlot. Maybe that they're using more of the homegrown feeds, more forages, than maybe a feedlot is using more grain and maybe some purchase grain on that side of things. There's certainly differences on the breakdown of these. And then operating overhead, annual cost of capital. It's a bit surprising to see some of the cow-calf number at 26, because the beef industry you typically think of as sort of a lower debt operation, but yeah. So on the cow-calf, certainly, we're seeing a bigger proportion on the cost of capital side of things than we see on the feedlot, and some of that is just because the numbers are so large on the livestock purchases and the feed side of things in the feedlot that the other numbers just become small in relation to those. And then the last one is the interest piece. So it does give you a bit of an idea of sort of the different cost structures for the different farm types. And then for benchmarking, one of the main things for benchmarking that is not just comparing yourself to all, and all is all of the farms that were in the business risk management data that we pulled from, and then we took the top profit farms, the top 25 of those 337, I believe, was the amount on the feedlot side of things. So we talked the top 25 in profit, so profit margin, highest profit margin group we then said, okay, what are they doing, and how do they look compared to everybody in the group? So you see, they're 10% better on the cost of goods sold, and then incrementally better on all these cost categories. So it's not that they're hitting home runs in all of them. It's just as they're incrementally better in all of these different cost categories. It is notable there that there's a 10% difference on the cost of goods sold. So they are doing things differently on the feed side of things and on the livestock purchases side of things to be able to have that better performance. So the difference is then you see the profit margin. So essentially break even for the group over the 2017 to 2021 time frame that we've got that's the most recent data we have. We're just in the process of getting 2022 data, and the top farms were getting a profit margin of 15%. So on that 2.2 million average sales within the farms in the group, that meant a $330,000 advantage for the top group versus the average in the group. So it's just a matter of one of those. What could I be doing to get myself closer to that top group to move myself to a better financial performance? So this gives you that ability to do some of those comparisons. Then this is the cow-calf numbers. So again, different cost structures. So we're seeing different numbers here, but the cost of goods sold, sort of the similar kind of thing, that they're incrementally better across the board on these. Cost of goods sold is another one where there's a fair bit of difference, but as well in the direct operating. So the beef cow herd was doing significantly better in those top two categories than the all in this group. So the top 50 were doing things differently on there, so to get themselves from, you see the bottom here of minus 12% profit margin for everybody in the group to positive 19%. So that was going from minus 16,000 profit margin or loss when we're looking at the 143,000 average sales for the farms in this, to a profit of about 26,000. So again, a difference for the cow-calf operators on the profit side of things. So it is then, then you can start looking at, where am I? And benchmarking is about what are these top producers doing, and where are their results lying, so that I can then start making some changes in my farm to try to move myself towards a little bit more to the right of that table, right? And what we also have done is we've taken the data and started looking at some common cost categories that make up some of those, the main costs in some of the main cost categories. So we lumped some of these. So the operating expense margin ratio is just your operating expenses, so it doesn't include the depreciation. So it's more of a cash operating ratio. So it just gives you an idea of, on the feedlot side of things, the differences. So again, that more or less that break even for the feedlots, but then the operating expense ratio. So this is their total cost divided by their farming revenue is what the calculations are here. So you see, the differences there, 14% difference on operating expense margin for those top producers. And then here you start to see some differences on the farm types, because on the beef feedlot side of, or even on the beef side of things, like energy costs and labor expenses are not typically big factors. If I was looking at greenhouse operations, the energy expenses, the heating, fuel, and electricity is part of the energy expense. So those certainly would be higher. Horticultural operations have quite a bit, more on the labor expense. So differences between the farm types, and it may not necessarily be on the feedlot side of things that they don't have any labor expense, but it's just so small that it doesn't register on a 1 decimal place factor here. But labor not being a big factor. And then we look at the machinery expense ratio, just to try to get a sense of, a little bit of a sense of how they're, handling their machinery capital. This is just their operating expenses for the machinery. So it just gives you an idea, not big differences across the group. So they're not not big differences on how they're managing the machinery. Then feed expense ratio, and I'll show you some of the definitions here in a bit. And it's important to know, especially on the feed side of things, what's included in this ratio and what's not, just because we're limited in some of the data of how granular we can get on some of this. So it is a sort of an approximated feed expense. So it's something that's useful to look within this database, but then trying to compare across databases. If you've got numbers from other places, then you have to use a bit of caution on those and make sure you're looking at what the definitions are for each one of these to get a sense of these. But 5% difference for the top group, and then the feedlot livestock purchases. So just trying to get a sense of what of that cost of goods sold piece is the livestock purchases. So, if you look at the feed expense and the livestock purchase expense, that's you're 85% of the way on your cost of production for the feedlot industry. And then health expense is not a big factor on a like on a percentage of your farm revenue, and not big differences between top and bottom. And here's the cow-calf, so you'll see the differences in the numbers here, especially when you look at livestock purchases, not a big factor here. So they might be buying in some new breeding stock and those types of things, but not big differences across the board on livestock purchases or health expense. So what we've done is just isolated some of the expenses that are included in some of those main categories, so that you can start doing a little bit of that drilling down to say, okay, what is it what is it within that cost of goods sold? If my cost of goods sold is looking out of line compared to what the average is, then I can look at some things like livestock purchases or feed expenses. If my direct operating is out of line, then I can look at the machinery expenses and my labor expenses, just to get a sense of whether there's some things out of line on theirs that I can start making some changes within my operation. And so, of course, with the benchmark information, you want to be able to use it to your advantage, and identifying areas of strengths and weaknesses is a big piece of why you benchmark. So here's just a couple of examples here. I've got Farm A and Farm B. They've got similar profit margins at 9% profit margin, and they both want to keep moving towards this 15% profit margin for their operation. But then you look at the cost structures on each one of them, they're a little bit different. So, the Farm B has pretty decent cost of goods sold percentage, but is out of line on direct operating and the operating overhead. So these would be some of those areas of where to look first within those. So direct operating, again, is the labor and machine operation would be things to be looking at. And operating overhead, there's a lot in there as far as accounting fees and membership. So it's just a matter of figure out what might be out of line on those. But Farm A has high cost of goods sold. So that's again on the feedlot side of things. It's a lot of times it's the livestock purchases and feed expenses, purchase feed expenses in that one. So then you can start figuring out, okay, that's where I want to start. So if I look at Farm A as an example here, so I've then taken Farm A, they're looking at, okay, what are some of those things that are in that cost of goods sold? So livestock purchases, some of those expense ratios, financial ratios that I showed earlier. The top livestock producers were 58% of purchases. Farm A is 64%, so that may be some area that they could look at. Not bad on feed, but certainly the livestock purchases would be a place to start, and a bit different on the feed, and then a little bit high on health, but not it's only a 0.6%. So really, from a management perspective, you want to be looking at where are my livestock purchases. Is there anything I can be doing? I know it's a commodity based market out there, but They're, the top farms are doing something differently for the other farms to have that kind of performance and be able to achieve that type of livestock purchase ratio expense. And so if you do, if you go through the process here and you flag the cost of goods sold is what is out of line, what are some of these areas that you can start looking at. So if your cost of goods sold is out of line, you can start looking at, because it's the direct inputs that are creating the outputs. So it's the feed, the livestock. On the crop side of things, it's the seed, the fertilizer that are generating the outputs. So, you can start looking at the production because they're mostly direct. They're the most direct link to the production side of things. So, so you can look at, what are my production benchmarks? What are my daily gains on my operation, and what is my market price that I'm receiving on that side of things? And then, of course, the livestock purchases and the feed and the cost side of things that you can look at there. The machinery operation costs would be a place to look, or the labor side of things are the main ones in direct operating. And then for operating overhead, there's really no rhyme or reason to what one to be looking at first. You just have to look at what the top costs are. If you're out of line on annual cost of capital, then you're looking at, am I overcapitalized? Do I have equipment or buildings that are larger than I need? So, is that a case where I should be looking at increasing my production to maximize the capacity of my facility, or do I need to be looking at right sizing some of my equipment to have equipment that is better suited or the right size for my operation? Looking at, is my land rent or my rental fees, is there anything out of line on those? And then interest expense, just looking at what those debt levels are for your operation. Excuse me. So another thing that you can be looking at is using it for doing some cost of production planning. So if you look at, you can, start plugging in some of your own numbers here to get to more of a per unit number. So you can use these percentage numbers to get to a per unit number. I've just used the top cow-calf numbers here as the example here. So if I estimating that I'm going to sell my 600-pound calf for a $3.40 per pound market price, then my return per calf is going to be in that $2,000 range. So then that $2,000 times the 32 gets you to the 662, so that my cost of goods sold is $662 per calf, and you just keep working your way down. So this is using the benchmark information. You can use your own information on that. So then you can use these benchmarks to then start doing some cost of production planning and seeing what, in this case, this is what the top farms are doing. What am I doing, and how could I, look at achieving some of these per calf numbers for my operation? And whatever these numbers are, you can use your own numbers in there. So, like I say, there's 13 farm types. 6 of them are livestock, and then 7 of them are on the crop side of things. So you can use them depending on if you got some field crops. You can use the field crops information and look at some of the farm types there. But again, these are nice to be able, because it's all consistently handled, the data. You can do those comparisons to see the different cost structures for the different farm types beyond just looking at the specific farm type that you're looking at. So this is the website that we have them at. They're at our OMAFRA statistics site. So you will have a copy of this presentation that you'll be able to go to those. So that's where all 13 farm types are there. So what I wanted to do now is, and I think every one of you had a spreadsheet that was sent out to you that I was going to walk a little bit through. I don't know if there's specific questions now on what I've covered in the slides, and then I'll just show you a little bit of the benchmark information and then tool that I've just sort of developed.
There's nothing in the chat yet, but does anyone have any questions to ask verbally to John before he moves on? We have a shy
If not,
bunch.
yeah, no, that's all right. So are you seeing my spreadsheet now?
Yes, I do.
Okay, all right, yeah. Just wanted to make sure I didn't share only my PowerPoint, and sometimes you get caught in that and you're moving around. You don't see the thing that I'm talking about here. So this is, I just want to show you the benchmark information that I've been talking about. So this, each one of the farm types that are posted on our website has, a definitions page, so you can see specifically what's all included in each one of these cost categories. So you can start working at, plugging those kind of numbers in from your income tax form, and then, some of the financial measurements that we've talked about, the gross margins and the profit margins, and it gives you a breakdown of what exactly is how each one of these are calculated. And again, the financial ratios telling you exactly what is included in all of those, so that it gives you the ability to then start doing some of those calculations for yourself. And this is where I was talking about, the homegrown feed side of things is one that I would want to point out is, just be sure that you understand what is included and what's not included. On the homegrown feeder side, because we're using whole farm data and the agri-stability data, the business risk management data, is we don't have an ability to do enterprises, and we don't have an idea of, how much of the costs of, the cost of capital are attributed to the homegrown feed cropping enterprise, and how much is in the crop labor, and how much of the interest is for machinery loans as opposed to real estate loans. So this would be more of a, these are the things that are included in that. So just be mindful of these are the things that are included. We don't have, it wouldn't be like a total feed cost, but again, using it within this database, it's useful because it's gonna track, and you're gonna be having, accurate comparisons within the database. But then comparing feed expenses to some other benchmark database or some other benchmark information you have, you'd really have to use it with caution to make sure you're including, or what's included in this benchmark, and and what's included in the other benchmark, and what are the differences from that side of things. So if you want more information on the standardized benchmarks, the Agri-Food Management Excellence has a paper on talking about, using it, and what are some of the benefits of it. And then we do a rolling 5-year average for these. So this is the 2017 to 2021. We are tied to sort of the business risk management cycle, so that's why it lags a bit, because like I say, we're looking at getting the 2022 data now, and it's just a matter of having all of the data verified within Agricor to be in a shape to be able to be used within the benchmarking. So that's why it lags for those. But so you've got sort of all the 5 years, so you can kind of see what's happened within the individual years. And then I presented all the 5-year numbers here, so you can have a look at each one of the individual years, and then for the all farms, and then for the top 25th percentile as well. So this is the top farms, again, looking at both the, this is the beef feedlot one, and then the cow calf one is for the same idea, the 5 years using it. So it's all the same standard format. We do have, a little bit of the production information that we have, so the average number of cows, and then do a bit of an estimate of how much of that is representative of the beef cow herd. Like I say, there's a lot of beef cow herds that are out there that aren't in this data set. So we have a fairly small number of the percent of cows in the herd, but we still have 26 farms. We always try to keep it over 20 farms in the data. So that's, we're, anything under 20, then we don't run a benchmark for those different farm types if we don't get enough farms in the data to do them. So this is the cow calf data. So every one of the farm types are formatted like this, so you can go through and and do those kind of comparisons. So the last piece that I wanted to look at or show you, and I don't know if anybody's had a chance to look through the tool. This has, I wouldn't even say it's hot off the press yet. It's not even off the press yet. It's this was I just finished this last week and sent it off to Lori and Emily. So I was, you're kind of my beta tester. So it'd be really good if you found some, there's always going to be some gremlins that are lurking in here that things aren't quite calculating properly. So it would be good to hear if you find those or ways that you think it could be improved. But it's taking that data and then putting it into the format, into these benchmarking formats. So the first piece is the income tax form. So taking your T1163, your statement A from your income tax forms and calculating, plunking it all into here. So you have that format with it, whichever income tax form you're working with. So I've just put some example values in here just so we've got something to look at when we get to the other ones. But we see, you've got the whole farm number here, and because we have done specialized farm types, so we haven't had to look at the enterprising out, but you may have 50% of your sales coming from calves and 50% coming from corn and soys and wheat. So then this gives you that opportunity to allocate each one of these. So if you had put say grew some barley, $20,000 worth of barley, but then you said, well, obviously none of that is to the cattle. So it's this enterprise that is then pulling into the other parts of the spreadsheet. So you can fill in everything that you have on your farm, even if it's not beef related, and then just allocate out what is not. So you get a pure look at it when we get to the analyzer stage. So you can input all of your own numbers into here, and this is all the commodity expenses. So it's all on drop down menus. So it's using all of the commodity codes that are within the Canada Revenue Agency. So you can whatever codes you can put in there, so you can enter what you have as far as costs on that side of things. And then this would be all the standard costs that are part of the T1163 form and related codes to it. So again, I just put through some dummy numbers in there just so you can have a look at.
John, may I interrupt?
Sure, yeah.
Richard is saying that the sheet has the macros blocked on his system. He says, I need to figure out how to unblock them. Any advice?
I did. I figured.
Oh, you got it? Okay. Wonderful, Richard. Thank you.
It's my system. Yeah.
Okay, perfect.
Yeah,
Okay.
yeah. There is some macros in here. So a lot of times when you open up the Excel, it'll identify that there's macros, and it'll ask you whether you want to enable or disable. So just make sure you're enabling them. Like I haven't built anything malicious in here, so you're not going to get your credit card information sent my way. You will need to have the macros enabled within your system to be able to use some of the navigation points is the biggest thing that would
Good
be
to know.
part of. Yep. So yeah, so then you enter your own data into there, and then you get the farm business analyzer, so it then puts it into that format that we saw within the benchmark format. So it's got your this particular farm. Again, it's the $110,000 of beef revenue, so it didn't pick up the 20,000 or so. What did I say for the barley? It didn't. It's only using that enterprise information for the beef enterprise. So then it isolates all of the information that you've entered here. So it gives you all in total dollar numbers for your operation. So this particular one is losing $30,000 a year. So they really want to do some benchmarking and figure out why and where they might want to look at. But then it does all of these calculations based on, it's all on a percent of 100, percent of revenue. So it's all 33,000 divided by 110,000. So 31% of your revenue goes towards cost of goods sold. 51% of your revenue goes towards paying direct operating expenses. So that's how you can read these. And then I have beef cow-calf and beef feedlot here so that you can have a, my intention is, once I sort of get this rolled out, is that you'll have an option to, select one comparison. So you could come in here as a horticulture operation and then select, I want to look at greenhouse cucumbers, and you can select it and it'll come up with benchmark comparisons. Like I say, just kind of put together for this session. So I just highlighted the beef feedlots ones here. So I have all, the all farms and then the top farm information here. So you can have a look at, this farm can then compare their data to the cow-calf. This was a cow-calf operation, so we're just going to be looking at the cow-calf numbers. But if you're a feedlot, obviously the feedlot would be relevant on that side of things. So, so then you can start doing a little bit of that benchmarking, right? So 31%, you're doing pretty good on cost of goods sold. Actually, this, even the top group is 32%. So, but again, you're losing $30,000, so there must be something. So then direct operating expenses, well, you're at 51%, and then 32 and 24 are the through the cow-calf mark. So you're quite a bit higher on the side of things. So one of the things you can do, I'm high on the direct operating. What are the main things again that are in the direct operating? Well, labor is one, and my machine operating is one. So they have a really high labor expense. Like I say, not a whole lot of cash labor is paid out on cow-calf operating. They tend to be owner operators. So the profit at the end of the day is more your salary. It's not something that you take out of the or expense it out. So they have a fairly high labor expense. So it's something they can then go looking into, what is it, why is it that I have that much labor expense? Or if they're machinery operation seems to be in pretty good shape. One of the things that I haven't done yet, because I was trying to figure out exactly how to do it, was to include the livestock feed expense and the livestock purchase expense and the feed expense, because that's of course on a livestock operation would be big factors in there. So it'd be good to kind of know, okay, maybe in that direct operating I've got some of my feed expenses in there, or if I'm out of line on cost of goods sold, livestock purchases or the purchase feed purchases could be out of line. So that's, once you've got all your data in there, then you can do that comparison, and finding out where you're out of line, and try to do a bit of that drilling down. The next one is then that cost of production planner that I talked about, that you can then enter your own information here. I just have, put in, 2024, this is your 2023 data. So now you're doing some planning for this year. So I sell calves. I'm planning to sell 100, and there's that, 600 by 340. That can be, that can change. If you're a beef feedlot operation, you can say, pounds, and sell 100,000 pounds, and my, at 250 a pound. So then you can, those numbers, and so then it'll calculate and I think potentially within your spreadsheet, I notice it may not be calculating these. So if you want, I can send out the updated version, which obviously then triggers these calculations, because then it'll calculate the 250, but it'll divide by the 100,000, so you get a per unit number, and then it'll calculate, based on these results that you have from your farm, the 26% of your farm sales, which would be 250, is that 65,000. So it kind of works through that process, and it also calculates some of those interest expenses there, so that you can do some of that planning from that perspective. And if you want to do it on a cap basis, it'll allow you to do that, so you can do it on a per unit basis. It's not just all on a percent of revenue or a per dollar revenue basis, it gets to be a little bit more of a hard number, a number that might be easier to wrap your head around. And then the last one is all that definitions page there. So yeah, if you get working through this and playing with some of the numbers, and again, there's undoubtedly a gremlin or two in here yet, so we'd love to hear from folks, whether yeah, if you can email Lori, or you have my email address. It's within the spreadsheet, but it's also on the presentation as well, so you can email me if you got that in. And like I say, in this business planner one, I think these links were broken for whatever reason, so if you like an updated version, I can happily send that out to you as well. So with that, that's all I had, Lori. So I don't know if there's.
Thanks so much, John. Are there any questions for John? Questions or comments? You can unmute or throw them in the chat, whichever you prefer.
Thank you. Thank you very much. That I like it. I like your calculator. I wish I was a little swifter and had figured out the macro lock on it sooner. I could have had it played with it a bit before tonight, but
Right.
yeah, pumping some numbers into it and having, yeah, I like it. So thank you.
Yeah, well, that was one of the comments. I presented this before, and one of the comments from, well, many of the comments from people were, do you have a spreadsheet that we can just plunk our income tax numbers in and it does it for us? And so it had always been on my to-do list to do it, but yeah, so this session was a bit of a push for me to get it done, at least in this, what I call sort of the beta version, right? And again, my idea is to have, you know, I mean, for you folks, I mean, you're in the beef industry, but if you've got field crops, being able to see all of those or choose any benchmark you want. So.
Yeah, well, that would be good because, yeah, we crop. We're looking to crop about 300, maybe 400 if we're lucky this year as well. So that would be a bonus to have that in there.
Yeah, exactly. Yeah, I mean that's the case with a lot of beef operations, that they've got a lot of other enterprises, right? And cross crops tends to be one of the main ones.
Yeah.
Thank you for those comments, Richard. Any other questions? I think what you delivered tonight was wonderful, as always, John. I'd like to thank you for joining us and always being so eager to help us out at Grey Ag. So thank you for that. Just give people maybe a minute or 30 seconds to just fire something in the chat if they so choose. Otherwise, Jay is saying thanks, John. So that's great. Otherwise, would like to say goodnight to everyone. Thank you so much for joining us in this webinar. And for those that are watching the recording, thank you for watching the recording as well. And do check out the website to see if there's any other of the 4 more courses that we're running that you might be interested in as well. Thanks so much, John. And I'm sure we'll see each other at another beef event in the near future.
All right. Thanks again for having me.
Thanks so much. Take care.
Okay.
Bye, everyone.
Good night.